Welcome to Redefining Technology, an Economist virtual event. This interactive conversation is sponsored by SunGard. Finance and technology have been inseparable ever since the invention of the abacus about 4,000 years ago. These days, technology is more complicated, and it affects both the way that markets are organized and the way that financial institutions interact with their clients. During the next 45 minutes, we'll be talking with three people on the forefront of financial technology, and we'll ask them about the technological challenges they're facing and how they're solving them. We're going to ask them about regulation, how it's affecting them, and we're going to ask them to gaze into the future and think about what might happen 10 years from now in their own fields. Now, I'm going to stress that this is an interactive presentation. That means that anybody who's watching can ask a question. All you got to do is fill in that little box below your screen, and it'll come to us, and we'll do our best to ask our panelists these questions. So we'll also be asking you to respond to a couple of polling questions, which will appear on the right side of your screen. So I want to introduce our three panelists. Jeffrey Bell is head of clearing and technology at Wedbush Securities. He's what I call the master of the millisecond. So when millions of high-frequency trades come blasting through the order systems, every second his firm tries to make sure that things happen in a safe and orderly fashion. Steve Ellis, to his right, is head of wholesale services at Wells Fargo, and I would call him a jack of all trades. He's involved in managing the technology for a wide variety of things the bank does. His job is to make sure that the bank's customers have a consistent experience no matter however they interact with the bank. And finally, we have Alexander Fleiss, who's chairman and chief investment officer of Rebellion Research. How about that? Alex is at the forefront of machine learning, developing artificial intelligence systems that not only work faster than humans, but also learn from their mistakes. I guess I'll start with Jeff. Your clients, Jeff, are anywhere from startup hedge funds to the biggest investment banks, but they all operate at very fast speeds. How do you help them control the risk in that environment?
Well, that's actually kind of a core part of what we do. A lot of people think that what we're building are technology platforms for just to make it fast, but really the art is making it fast and reducing the risk while you're doing that. So it's a series of buying power types checks and a series of different regulatory type checks. But the key is being able to do also those checks and that validation very quickly. We have systems through partners. One of my other jobs is CEO of Lime Brokerage, and Lime is a trading technology firm. And we build all of that. Wedbush happens to be a large client of ours. It's finding the right types of systems, the right performance mix for your clients, and being able to deliver that to them day in and day out.
So when you talk about real-time risk management, you're talking about speeds that are very hard for people to fathom. I mean, we're talking about what level of speed and how quickly do you need to get these risk approvals back and forth?
Yeah, our fastest risk check on our Lime Direct system is about 200 nanoseconds. So that's 200 billionths of a second. That's insanely fast. I think it's the fastest in the market. We're pretty proud of that. It's quite a nod to our development team who's built and created this unbelievable technology. It's something that we've built and improved upon over a decade of experience in the automated trading markets. So incredibly fast. A lot of people measure things in millionths of a second, microseconds, and we're moving into nanoseconds.
And the advantage of a nanosecond kind of risk approval, what does that give an automated trader?
Think about it as time can be split, infinitely almost. And if you knew something or were able to do something quicker than the next guy, whether you have it at 1 second or one, microsecond, it's still a period of time that you have an advantage over someone else. So speed is still a very important part of Wall Street and trading.
So you're offering them a real-time risk management system, but let's say Morgan Stanley, they probably have a dozen different risk management systems. Why do they need another one from you?
Well, there's something, benefits that they get from being on a, independent perspective and being away from their current system. So Morgan Stanley, although not a client, but if they were to use our system, they'd get the benefit of the independence, they'd get the benefit of the performance, and they may be able to migrate certain elements of their trading that's, let's say, more sophisticated or more time sensitive away from their corporate systems and onto Lime or Wedbush's systems. And so we could give them a meaningful advantage over their current system. So big firms like that have massively complex large systems that they have to work with, and massively complex large systems don't typically have the performance that we do.
And on the other side, the smaller clients, what problems do they have that you're trying to address?
So for smaller clients, I think the issues are more around, they're still speed sensitive to be sure, because that's an opportunity for them in the market, but they're also interested in just a complete package, a turnkey service, the ability to reach out and connect with the engineers and understand market structure, understand how things work. So it's more of a consultative approach as opposed to just a system that we can drop in. So it's a combination of service and technology.
All right, Steve, you're doing a lot of things at Wells Fargo, but one of your main client groups are the middle market companies who come to you for commercial banking services and things like cash management. So what are their biggest problems that your clients are facing, and how are you trying to help them with technology?
Well, what we think of with our customers is they interact with us in several ways. They come to talk to a relationship manager, maybe they're going to the branch to do some activity, or they're coming to us through the internet, or what used to be just a PC, but now it's smartphones, it's tablets and phablets and Wii's and all kinds of things. And it used to be able to, you just had to build for a desktop screen. But now your customers are using desktops and they're using mobile phones and tablets, and now you want to build once and deliver to all those devices based on who the customer is, the feature functionality of the device, the situation they're in, and their preferences, and figure out how to deliver a consistent experience regardless of how the customer connects with you. That requires a new way of building, which we call responsive design, which I think you guys have heard about out in the industry, as well as like doing work in your infrastructure to create a common connection around customers, products, and organization so that you can deliver that consistent experience.
And in terms of commercial, we all know about retail clients and what they want from the internet. At least we're consumers of it. But commercial banking clients, what do they want from you, and what new services can you provide them?
Well, most of our customers, they really don't want to spend a lot of time on financial services. They want to spend time working with their customers and understanding their business strategy. So the first thing you do that the internet really helped you do was customers could spend less time setting up payments, dealing with receivables, that kind of stuff. And if you can take time out of the equation, time is money to a small business or a big business. And that time, then they can say, well, if it's less time doing that, more time to work with my customers and run my company. So that's one big chunk. The second piece is there's a lot of data out there, a lot of information. And when you can make data smarter or push stuff up to customers to help them make smarter decisions, help them collect data better, maybe do routine transactions automatically so they can focus on the stuff they have to do to add value add from how their brains work and how they make smarter decisions. That's the game.
That's interesting. Tell me, give me an example of, let's say I'm a hot dog stand, and maybe something bigger than that, a carpet warehouse or something. And what data could you provide to them?
Well, let's not take the hot dog stand, but we could, right? As long as there's a lot of them, right? You take a business that's got maybe 10 locations.
Yeah.
They're taking money in all those locations. How do I collect and show them all that cash, what their cash position is on a real-time, intraday basis, right? Because they're taking stuff in during the day too, so they can then say, okay, here's how much money I got. Now I got to invest. I got to disperse. So you give them a better idea of their cash position and their estimate of just when they have to move money out, so they can leverage and manage their money better, which gives them more liquidity, which is a big thing for them.
Okay. Alex, we're going to turn to you now. Rebellion is working on machine learning, which provides new insights in the financial markets, insights that previously may not be available. I guess that's the idea. And you use those insights in two different ways. You are an investment manager, and you manage money, and you also sell ideas to customers as part of a boutique research outfit. Is that
I wouldn't say we sell ideas. We have an economic report that we publish, and we offer our customers that. And through that report, we cover about 46 countries, and a number of asset classes. So with machine learning, you have a few advantages. Number one is our ability to cover a huge, array of data. So, we're able to be, forward on, for instance, Argentina's equity market. We had very negative signs in Argentina's equity market about a month before it crashed in, January, February 2012. At the same time, we actually were negative on the Greek market before any of the major ratings firms downgraded them back in 2009. So with machine learning, you're able to take in, the equivalent of information that would necessitate thousands of analysts to cover. So we're able to be forward on Japanese consumers. For instance, we got very positive on the Japanese consumer in December and January, and we were seeing significant strength out of them. So, this is...
Let me ask you,
Sure.
Well, what is it that a human analyst would miss? And
Well,
what are
I
the
don't,
so I don't quite understand.
we're not trying to replace human analysts.
Uh-huh.
See, I believe that our technology, it's really, I like to see it as a cable versus satellite. One's not going to replace the other. They're just different options in the same market. Human analysts are great. You just need a lot of them to cover a lot of things. The benefit of machine learning is that we're able to cover 46 countries without having to hire 5 analysts per country. So, really, this isn't a world that will never need humans. I think we'll always need humans. I think that the machine learning part of the world will become a much greater part of the market.
Let me ask, we're going to have, if you have any questions for our panelists, I'd like you to send them off to us. Just write in that little box and press that button and we'll deal with them. We also have a poll for you to respond to. Financial regulators have created a whole slew of new rules and regulations since the financial crisis. Sometimes new rules help the tech side develop and sell new products, and sometimes they stymie innovation. The question is, are your innovation technology goals being stymied by regulation? Yes or no? I want to talk now about regulation as it affects high-frequency trading. I guess, Jeff, you'd be the point person here. Regulators have been trying to get a handle on how to control the risks of high-frequency trading since, well, at least since the flash crash, and certainly before. And they're worried about the stability of the financial markets. What do you think of their efforts? What ways are they making financial markets safer, or what ways are they just adding to the problem?
Well, I'd say I think they've been working on that for a lot longer than, since May 6th of 2010, the flash crash. I think it's been going on for quite some time. I think the rules are just becoming more crystallized and the expectations are becoming more crystallized. They've put more teeth in it. Great example, and one that I'm very close to, the market access rule, and it's known as 15C3.5. It lays out the responsibilities of people providing market access, broker-dealers providing market access. And you have to have a suite of regulatory controls and financial controls. And it makes me think about the question you just asked the audience, and maybe I'm speaking a little out of turn here.
No,
but
go ahead.
Thinking about, does it stymie or does it stifle or does it create innovation? And I think the answer is it does both. If you look at some of the best innovations that we're building at Lime and Wedbush, it's things like our pre-trade system at 200 nanoseconds, or our post-trade system that's about to be announced that we think is a really incredible product. But at the same time, it stifles in some ways in that you have to spend a lot of time and attention on compliance with the regulations, on review and audit and risk management, and that takes away resources because ultimately you're in business to make money, and so if your resources are being pulled away from one place, that's less time you can spend on other things like innovation. And but I think on the whole, on balance, I guess it's a good problem to have. I think it's important that we have strong investor confidence in the markets. I think issuing companies, individual investors, asset managers, everyone through the life cycle expects that to be the case. And high frequency trading, or automated trading, I guess is more appropriate, is not something that people in my mind should be scared of. I think it's a natural evolution of technology becoming more pervasive, and it's just a replacement for things that humans used to do. And kind of similar to what Alex is talking about, it's if you you can do a lot more. You can provide more liquidity. You can tighten spreads. You can decrease the cost of transactions by doing it. These are all wonderful benefits for the marketplace.
Alex, I guess you're closer to the front lines on this one.
Well, I wouldn't really say so. See, the common misconception about quants is that we're all high-frequency players.
Yeah.
When my technology really competes with, the Nouriel Rubinis of the world and the Bill Millers of the world.
Yeah.
So I like to think of my technology as a robotic economist that we've also, worked on to look at fundamental information as well.
But a lot of your, let's say, cousins in the business use artificial intelligence to program algorithmic trading.
The vast majority of AI, maybe 99% of AI is used for algorithmic trading, yes.
So you talk to these people, and you look at the market. What do you think what regulations have worked, and what do you think are really have been destructive or unhelpful?
I think that Germany's recent regulation that got put into effect in March was some good regulation. It was, a lot to do with, disclosure and investor confidence. I really agree that you need regulation for investor confidence. At the same time, of course, red tape will always stymie growth. There's no question about that. The more red tape you have, the less growth you'll have. There's no way around that. So, I think high-frequency trading is a valuable part of the markets. As long as we have good regulation, it's not politically motivated. That's my one worry with regulation always is that it's politically motivated as opposed to being, for investor confidence.
Steve, any thoughts?
Well, I think I'd come at it from a slightly different angle, which is more around how you know your customer.
Mm-hmm.
And I think to the points earlier, this started a long time ago. And really, 9/11 was a big push around knowing your customer, Bank Secrecy Act, all those kinds of things. And the regulators got much more involved in day-to-day operational processing. And I think that has some pluses and some minuses. The first thing is, by the way, you should always know who your customers are. If you don't know who your customers are, what are you doing in business? And you're probably not going to be very good at business if you don't know your customers.
Right.
So we always put a very high premium on that. I mean, that's why we are in business at the end of the day. When we talk about red tape, so now there are more compliance and more rules of the road around that. And you do spend more time, to his point, on dealing with regular making.
And how many people has Wells Fargo hired to deal with, Dodd-Frank? I'm sure it's in the hundreds.
Well, if it was only 100,
Yeah.
I'd be happy.
Okay, so I stand corrected, it's in the thousands.
No,
So.
but the point, and I think it's right, is that you have to deal with it. So you're in business or not, and you have to figure out how to make. Now, can you turn compliance and stuff around and make it a competitive advantage?
Absolutely.
Because everyone, that's the big question. That's what I think the game is here with this. Not a game, but there's so much pressure on it, and everyone's dealing with it. It's not just us. It's like, how can I make that easier for my customers so they can do business with the bank and with the company?
Yeah, there's no doubt that you can turn it into a competitive advantage. I mean, I look at the services we provide at Lime as an example. We service a number of sell-side institutions that traditionally compete with us, but they're facing the same challenges we're facing around how do we get this done, how do we do it economically, how do we do it efficiently, and they don't want to take the time or the energy or the investment that's needed to make that happen. So they're happy to outsource to a trusted firm and one that can get it done.
The other issue for us in that is the change of Basel and how Basel works around capital ratios, because now they're allocating capital differently to different kinds of assets and like those you have, and that can change the economics of products and how you look at your business models, right? So that one's it's different, right? So you have to think. You have to approach that from that perspective, right? If the economics change, then does it make sense to be in? Can I rearrange how I do this to make it an economically profitable business? And if those rules make it different, do I stay in that business?
Have the Dodd-Frank and other regulations discouraged you or helped or encouraged you to move away from certain businesses or put less emphasis on certain businesses?
It does change. It will change your approach. But again, you have to, I think, be calm and reason and thoughtful about it. A lot of times something new happens, and it can happen with new technologies too. It's that uncertainty. Everyone can, particularly in banking, oh my God, that's bad, and we don't understand it. But once, a lot of times I think people overreact to those things. So I think you want to sit back and say, okay, let's really think this through and be thoughtful about it. Make sure we understand all the impacts. Because sometimes these rules come out and you see the primary impacts, but you don't see the secondary or tertiary impacts of it. And you want to take the time to be very thoughtful about that before you make any rash decisions.
Well, look at Dodd-Frank as an example. You know, we've seen over the last few years, since it's been contemplated, Volcker Rule and et cetera, we've seen more and more of the, what they're trying to do is de-risk banks and take some of the proprietary trading out of those banks. We've seen them turn into startup hedge funds, startup asset management firms. They've joined smaller, more nimble broker-dealers, and they've executed those trades on either a smaller scale or a different scale. So where it's a problem for one firm, it creates an opportunity for other firms. So
I'm hearing that it could be all this regulation isn't necessarily a bad thing. Maybe it's moved the risk to where it belongs rather than public institutions to smaller hedge funds.
I think it can help with that. Yeah, I think your point about what it does to innovation, it could probably do both. The problem if you're in a bank and you did something new and it created a customer problem, you're going to get slapped around that. And I think people worry about that. And I think you have to shift. So they do. That's just what's happened. And I think as we've come out of the recession, things are getting better. We can shift more now and get more focused, because at the end of the day, it's about customers and that customer experience and that culture with the right balance of risk and risk management. It's not about risk aversion. It's about risk management, providing customers value-added services.
Yeah.
I'm wondering if we made better risk tools, could we need less regulation? Is there some relationship between the two of those things? I mean, I think originally the idea behind this.
In a utopian world, and unfortunately we don't live in a utopian world.
Yeah.
So,
yeah.
But I do think if you get in, the way I think of this, like when mobile banking came out, that was something new. A lot of people were nervous about it, and the regulators were nervous about it, right? And I think getting in front of that with the regulators, setting those meetings up and saying, here's how we think about this from a business. This is the value to customers. Here's how we're managing the back end. Here's how we're managing risk. Here's how the things we're thinking about. I think being proactive around those kinds of things is the way you make things better, and that you actually probably keep things from maybe something bad happening in a reactive way, whether it's politically motivated or what it is. There's a regulation that isn't good for your customers or your business. So I do think being proactive around these things when you can be leads to a better result for everyone.
All right, I want to read the results of our first poll. We asked you if you felt you were being stymied by regulation, and the answer was 42% said yes, and 58% said no. So I don't know, guys, what do you think of that there? Does that surprise you, or does that strike you as a reasonable
I would have
data?
expected the no to be a little bit higher
on
my side, just because I think for every little bit that it does stifle, it also, I mean, we talk about it all the time. We're creating new products and new opportunities and new markets because of regulation, and so it's good.
Okay.
I would have thought the yes would have been higher, that it would have been more. People would say it was stymieing or slowing them down more.
Of course,
because there's more red tape, as you said.
The big banks are going to be hit more by regulation.
Yeah.
So, as we were talking about the migration of these great prop traders going from, Wells Fargo or Goldman Sachs to the new startup hedge fund being seeded by, whomever, that benefits a small guy and that hurts the big guy. So, really, what regulation is doing is taking the risk away from, the big banks. So, for the consumer, for Main Street America, regulation is probably a good thing because it'll increase investor confidence, and with investor confidence, you have a better market.
So I got two comments on that.
Yeah.
So one is, I think the regulatory pressure on banking is not good for small banks, because the cost to implement be a bank is higher than it was before. And I think that's not good for the community small banks.
They've complained a lot about it.
The other thing is, like, we bank lots of businesses, so that's why I was a little surprised, because they, particularly BSA and the Know Your Customer stuff, can be a headache for businesses, particularly when you're in any sort of money service, and you think of a lot of innovation around payments and electronic payments and mobile payments. This is a place where it's hard to understand the regulatory requirements around it and understand how that operates in a day-to-day piece. So I was a little surprised by that, but I'm glad to hear it, actually.
Okay. I want to move from regulation to talk about what our panelists see in the future. We've talked about a little bit about machine learning, but what are the new technologies financial firms will have to incorporate in the future? What are the new ideas that have caught your interest? And as you guys think about that, we're going to ask a second poll question. And the question is innovation or regulation more important to address risk? Is innovation or regulation more important to address risk? In other words, do you think innovation is more effective, or regulation, I suppose? That's our polling question. I'm going to come back to our panelists, and I'm going to do a little crystal ball gazing, okay? You're all, and I'm going to look at the future in 2 or 3 different ways. The first way is analytics, because you're all working with analytics one way or another. Jeff's trying to come up with faster real-time risk management, and Steve is trying to use analytics to probably mine the data that your bank collects. And you've got your data set is the entire investment world, right?
Yeah.
So let's imagine it's not 2013. Let's imagine it's 2023. A little scary thought. And how
I'll be retired. I'm scared at all. I kind of like it.
I'll dream of it. What kind of analytics will we be using? What's going to look old-fashioned? Anybody?
Well, I'm going to give you my view of the future, okay? I'd take out this phone. Let's assume it's not a cracked iPhone, but I just talk into it, right? When I push this button, it says Wells Fargo, obviously, because it's the best bank, right? But and I just talk into it. I say, hey, this is Steve. I need to move money to my younger son. Take it out of my normal checking account and move the normal amount. Yeah. And by the time I got done saying that, the bank had authenticated me from my voice and my phone and a bunch of other stuff we do behind the scenes that we would never tell you guys about. It would understand all those words I said, what I need to do, understand all the data about me, who my younger son is, what my normal checking account is, the normal amount I move, and I'd get a response back and said, so you want to move $1,000 to your son Tony out of your normal checking account, is that right? And I'd say yes, and I'd be done. That to me is the future. Yeah. Using stuff, the bio stuff, the things about who we are and how we do things. And it's not about keyboards and mice and PCs, it's about me and things about me and how people use things about me, my voice, eyeballs, whatever, how you want to think about it. Leveraging stuff from an authentication standpoint. And then using all that data in the back end. And we can talk, and these guys probably don't worry about big data than I do and how to take reams of data. But to me, a lot of it's siphoning that data out to use it to provide that right customer experience to a consumer or to a business.
That sounds like your area, Alex. Artificial intelligence. So
we are thinking about the customer experience as well. And currently, we provide an economic report, but for us, the next level is to become an equity research shop. Just like Morgan Stanley has equity research. We, in December, when we saw the Japanese consumer, was strong, Sony made a lot of sense on our technology. So, we could have issued a research report saying why we liked Sony, why we were cautious on Sony, and that could have been useful, and that could have been completely computer-driven. So, in time, I view Rebellion Research as, a much larger research shop in terms of getting specific, offering country-specific analysis, offering, company-specific analysis in, 30, 40 countries. So, on top of obviously growing more products on the asset management side and having more individualized products, this is something that we can take and go all the way with. There is no part of finance that machine learning cannot compete in. I don't think machine learning will ever replace human beings, really just about in any part of finance. You're going to need traders, research analysts, portfolio managers. AI and machine learning, a branch of AI, will really just be another market participant.
I'm just thinking about, let's suppose the whole point of machine learning is machines learn from their mistakes, right? So let's say you set off a million of these machines.
Yeah, but what it means to learn from your mistakes is that you can take that technology and set it off on its own, and it can be an observer and an analyst in a global financial market.
Right. So I guess that's what what I'm saying is, if we spend 10 years, let's just say, learning from our mistakes and using machine learning, how much smarter are we going to be in 10 years? What do you think we might be able to do analytically that we can't do today?
Well, what's really going to drive innovation is how strong the technologies are going to get. I mean, you have to realize that probabilistic AI only came about in 1989. So we're talking about a very short lifespan. Actual AI was only invented in the Dartmouth campus in 1955. So this is still, we're not even at the dawn of AI. We are at the pre-dawn of AI.
I agree. I think in 10 years, firms like his are going to be at the forefront of finance and industry. I think it'll become more mainstream. It'll become more expected. Firms will develop experience in those areas. Just like we have research analysts, we have some fantastic research analysts, and they've developed over the years. You're going to see other parts of the market, quantitative AI, that type of thing, taking over. I think the technology is always going to improve. I think Moore's Law is alive and well, and we're going to see that continue. But it is moving in some ways toward commoditization. So for automated trading, for me, building a robust infrastructure and having a fast environment is almost expected for you to be in the market, where the real development and effort comes in. And I think a lot, not to knock down what we do, but I think the development of strategies and alpha, that's ultimately the most important part, because as our clients are successful, we'll be successful, and that's where we're going to see things.
But it's very new stuff, right? And I think
it's all cutting edge.
Exactly right.
Yeah.
And I think a lot of people think it's much farther along than it is, and whether it's the dawn or baby steps. I mean, I really think that's where we're just starting to learn how to think of structured data and unstructured data, how to pull it together and find some interesting insights, whether it's macro or whether it's around individuals. When you think about retailers trying to work with their customers, which you can think of the bank as a retailer,
Think about all the
we're just learning.
fraud prevention.
Yeah.
There's so much fraud
Unbelievable.
prevention. I mean, and people are using AI, to hunt terrorists right now. So I mean, my partner, before we started Rebellion Research, was working for a terrorist consulting firm, a terrorist hunting consulting firm that worked with the CIA and NSA, and he was developing technology to look for terrorist agents in other countries. And
Well, I'm curious, though. You got me going here. So in theory, if we become more efficient at analyzing data, we won't have to rely on a sell-side analyst coming up with a wrong answer all the time. I mean, are we going to be actually going to be
but computers
smarter?
have wrong answers too,
Is that
though.
right?
There's still going to be wrong
Yeah,
answers.
computers aren't perfect. Humans aren't perfect.
Are
The
we going
world's
to be,
not-
are
the
we
world's not
more
certain.
accurate,
No,
or are we
the
just
world's
going to be
not
the same?
Indeed.
Well,
Is it going to be the same thing, more or less, except it comes out of a machine rather than Dave or Sam?
I'd say think about it, the way I think about it is, think about, human beings make mistakes. If they have more data, they make less mistakes because they can do more with it and they can come up with better.
Unless they're making more decisions, then they might be making more mistakes.
That's a possibility. But again, it comes down to how much you can crunch and how much data you can handle. And as technology progresses and you can correlate more things, I mean, our firm, we have historically sent people out to malls to look around to see what does the parking lot look like on the day before Thanksgiving at this mall? How does the flow of traffic in and out of Abercrombie and Fitch matter? These are all things that everybody's heard about, nothing super special. But now imagine you apply some technology to that and you can actually map to transaction, and you can map to gas stations, and you can map to smart cars. I mean,
So I would
you have
say
tons of data.
It's very interesting because we bank a lot of casinos, and that's probably one of the smartest industries you can think of around how to use data around their customers, and they've been at it for a long time, much longer
And
than
they're
anyone
getting
else.
better
They're
at it.
probably more sophisticated than anyone else. But I think this is right. This is where people are going, and you mentioned mall developers, and we bank a lot of mall developers, and this is exactly what's on their mind, right?
Absolutely.
Because their idea is they're managing a mall and they're trying to help their people in their tenants be better and more successful, right? And that's by managing traffic patterns, all kinds of stuff.
I want to ask you about the markets you're involved in, because right now they're going pretty fast. I mean, and then 10 years from now, are we going to get that much faster? Where does it? Is it diminishing returns? What's 10 years from now? What is it going to look like?
I mean, my opinion is it'll be faster, but will it be,
10 times faster than it is now?
I'd have no prediction in terms of scale or change or whatnot. What happens though is, as the technology becomes more pervasive, more people are fast, and that becomes less of a place for competitive advantage. 10 years ago, if we were having this conversation, technology was a key driver in delivering alpha to your particular strategy, and it is still a key driver, and it's a great example of it sitting at the table here. But it's not necessarily the speed game 10 years later, as much as it is the intelligence game. And so that's kind of the way
I think that's right.
The way I think
agree with
about it.
Alex, do you have any ideas about
I think he's completely right. I completely agree.
Completely.
I think he spoke very true words. It will be less of a speed game and more of smart data analysis game.
Yeah, totally agree.
I had
So
a.
that's where it's going to be. It's about making data smarter to people.
So speed is going to be less important.
Well, I think
And-
speed
and
is
it's
It's a
and-
relative,
and
it's a
analysis-
relative advantage. It's not as high as it once
I
was.
see.
It's like the same thing
Because-
as like people talk about how fast does money move, right?
Mhm.
And people say the money needs to move right away. I've never heard a customer say that, by the way. They just want to buy stuff. That's all
Yeah,
they want to do.
that's right.
As long as I buy stuff, I walk out with something, I'm happy, right? It's installment, doesn't matter when the money moves to them. We usually think around fraud because that's, I think, a good place where you start
Yeah.
thinking about how to use this stuff.
I mean,
But the game to me is about how do I help people be smarter about what they're doing? And I think that's what you're doing, right? And that's what you're doing.
Yeah, I was talking with a colleague last night at dinner, and one of his comments was, think about attracting someone to a website or to an app or something like that. It's not terribly difficult to attract someone to your site, but it's incredibly difficult to attract you or you to my site. And you don't know me, and I said, I want to figure out how to get to you. In 10 years, it'll be easier to target
Yes.
both of these guys. And then I can actually be very specific and delivered in my pitch for my product, which is great for my business. It's very efficient. I think that type of thing that's the
That's
big
the
change.
promise. That's
Yeah.
the promise.
We've been talking about the future of desktop really kind of computing in a way, because these are big kinds of things the traders use. But everyone's talking, of course, also about mobile devices. And is there any kind of interesting thing you think might be happening in the institutional world with different kinds of platforms like that? Or are we still typing away at our desks and in front of our screens?
I think that stuff's going to go away. I mean, I have a computer, obviously, and I have a nice old keyboard in the classic style, but I use my iPad for everything. I mean, I can't live without it, and I think you're going to see more of that. You're going to see touch, you're going to see voice, you're going to see just continue to improve.
The ease of the consumer. Technology is going to make life much, much easier for the consumer.
Yeah,
All aspects of
I
life.
think the seeds of extinction were sown for the PC when smartphones came out. And I think PC makers, I think that stuff's going to go, even if it's a PC with a keyboard, it's going to be touch.
Yeah.
You know, there's no doubt things are moving much more to how I do things.
I mean,
Right.
why do you have to be anchored to
more.
one place? Why
Yeah.
can't you have a
Yeah.
to-do list that's a pad over here, a calendar over here, an email system, a phone over there, but they could all be the same device with different applications running? You arrange it how you want, you touch. I mean, I think you could do that stuff easily today. If they all collaborated together and worked seamlessly, it would allow you to be the way that you want to be.
Yep, totally agree.
So, let me ask you a question that came in from the audience. Is regulation diverting investment on more consumer-focused technology? How do you guys think about that?
Diverting investment.
Yeah.
I think in some places it is, and I think it's a short-sighted approach. I think if you're watching what's going on with consumers, they don't care about what's going on in the regulatory world, right? They care about how they do things.
Yeah.
And if I look at my 30-year-old and my 20-year-old, they're very different people with how they use technology and devices to get things done. And if you're not thinking that way in your business and you're saying, well, I can't do that because I got to deal with these other things, you're making a mistake, in my view.
I agree.
Let me ask another question that occurred to us. How do regulations and your technology impact drives to expand into emerging markets? How do regulations and your technology impact drives to expand into emerging markets?
Well, I'll take that. I think, at least for us, a lot of people look to the U.S. markets as being the fastest in the world and as being, highly effective, efficient markets. So, when we're a product leader in the leading market, it's natural that other markets look at us and say, okay, well, we're going to follow your regulation because you must have put some thought into it. We're going to follow your technology concepts because they seem to have won in a large market. And we're seeing it today. We're trying to take our technology and drive it more internationally, and we lead with technology. We don't. We offer brokerage and clearing and a number of other services, but internationally, to expand, it's about technology and innovation and being able to bring our products to those markets.
Yeah, for us, like our business customers access our internet or mobile platform from over 160 countries over the last 6 months. So they're everywhere. That's where our customers are. And the regulatory worlds are very different in different countries. And so that takes a lot of thinking about how to deliver things efficiently and effectively when you're dealing with different environments like that, and it gets it actually. We'll get down to like where the data is, who can see it, who can touch it, who can deal with it, and the privacy issues are all tend to be a little different. So it adds a layer of complexity, not necessarily the regulatory piece, but just the fact you're dealing with all these different countries.
Yeah, regulation is actually helpful for me in emerging markets because the more that companies have to file, the more data is available for me to do smart analysis on. So, for Chile, the more information, the better, really.
They announced some poll results. So it looks like when we asked you to figure out whether it was more important to address risk via innovation or regulation, it was 78% said that innovation was a better solution than regulation. That's sort of an interesting way of looking at it.
This is a capital society, so
yeah.
that's how we're built. Innovation
leads, and the regulation ultimately determines which one won. That's the way I think about it. I think a lot of people, take market access.
What do you mean by that?
Well, I think I'll take market access as an example.
Yeah.
A lot of firms had ideas about how to perform market access, and a lot of people were on different sides of the debate and the equation. And after a thoughtful approach, ultimately the regulators come out and say, this is the way we're going to do it. And they've sort of validated the process of different firms. And there are winners and there are losers, but in a way they're kind of doing that. But and we've all heard the story about the regulators being behind from that standpoint. I think in some ways that's normal because the innovation and dollars and energy and effort obviously are going to be on the front line of trading as an example, and the regulators, their job in my mind is to keep pace, and I think they're doing a good job at that. They've got all sorts of new technology initiatives that they're working on, and they're leveraging technology in ways that they never even probably imagined 10 years ago. And so I think I think they've done a good job, and I think it's going to continue.
Yeah, it sort of raises the issue, though, of whether advances in technology are going to make us a safer society or we'll have a safer financial system. And some people would question that.
I don't, because at the end of the day, the people who have the money on the line, the people who are risking their dollars, ultimately it rolls back to someone, either a shareholder, an individual owner, someone like that. They're very focused on preserving that capital. They want to grow it, and they want to take risk. That's what we get paid to do as firms, but they want to protect it.
Well, yeah, there's higher human error than there's computer error. So computers will make mistakes, but humans will make more mistakes. So for fraud, fraud prevention at Wells Fargo, I have no doubt that in 10 years, their AI technology is going to make a much better job than their current fraud office. It just they can look for more factors and more red flags. So that's really the way I see things moving. We don't want regulators more than keeping pace, because when they go from keeping pace to trying to get ahead of innovation, that's going to slow down GDP. We want them keeping pace and no more so.
I think it's how you use technology, right? I think sometimes people think technology is the answer, which I don't. I think it's an enabler.
Yeah.
But let's just take this phone. So how many people walk around, they don't know where their cell phone is? We all know where it is, right?
Mm-hmm.
It's usually right with you. So if someone's using my credit card in San Francisco right now, and I'm in New York City, and my phone's in New York City, what are the odds it's me using that credit card in San Francisco?
Yeah.
Like zero, right? I didn't have that information before we had GPS on these phones. I didn't have location-based services. And that certainly is a very valuable thing, I think, to figuring things out. And I think to his point about technology, it enables you to see things much faster and unusual trends or patterns, out of pattern behaviors that might indicate somebody's doing something they shouldn't do, which is really important to us and how we think of fraud prevention. I would say this is probably the most innovative thing, one of the more innovative spaces for us, is how to use these new tools to help minimize fraud.
That just happened to me. I mean, just this week, a colleague of mine was booking a part for an event that we're doing next month, and I got an alert on my smartphone. It's from American Express, and it just said, "We think there's fraud. Tap here if this was you." And I thought, how great is that? Much better than the old way of doing it, calling me at my house, me getting home and realizing, nobody's got access to the credit card because I've been cut off.
Before it, yeah.
I mean, it was beautiful. It was really smart.
Yeah. I mean, I think you're just going to see more and more good things to come out of it. People get nervous about it because it creates, they don't understand the change to how business models work. But
Well, they're worried
reality
that
is-
that
Yeah,
the
go ahead.
complexity will increase risk. And as things get bigger and more complex, there's a risk that something will screw up. And I guess
guess it's a-
that's the basis of everyone's
Well, I
fear.
think- I
Yeah,
would think-
you don't think that's...
Well, I
This-
don't think it's one or the other. Look at it with flight. With flight, I don't want just a machine learning system, flying my 747. Right. But I would love to have a 747 flown by machine learning and a pilot. Okay?
Absolutely.
The majority of planes go down from human error. Now, with JFK Jr., for instance, if he just looked at his horizon, he would have known not to make the left turn. A machine learning system could have said, you can't make this left turn, that will put us into a dangerous spin. A simple, extra co-pilot. See, with your point earlier about will machine learning replace humans, I think machine learning will work with humans.
Augment, yeah.
Totally.
On that note, I'm afraid we have to end. I want to thank our three panelists for participating in a very interesting discussion. I also want to thank those of you who participated by sending in your comments. And finally, I want to thank SunGard for sponsoring this interactive conversation. We hope to see you again.